South Africa's Standard Bank is the biggest bank with a market cap of 171 billion rand. It has a 150-year history in South Africa, and since 1980 has built operations in 18 African countries, where it also trades as Stanbic. It is 20% held by ICBC of China and has a price-to-earnings ratio of 11.6, dividend yield 4.7%, and their pref share has the star code SBPP. Would you touch Standard Bank? It used to be the darling of the market.
Yes, look, and I mean, we're not talking so much about Standard Bank, the shares today. We're saying this is the big elephant in our local banking environment. AAA rated, the one that everybody pays the most attention to. This is what its pref share, SBP, looks like. And you can see that roughly it hovers around 100. Because it was issued at 100, and that's what you'd expect. You'd expect as interest rates go up and down, that's what happens to the traded price, because it's paying out this fixed amount relative to the prime interest rate. I think the interesting thing here is this is the market leader, and just to put it in perspective, there are roughly 5.3 billion rands worth of these units in issue owned by members of the public and institutions and others. So that puts it in perspective, 5 billion relative to 170 billion market cap for the company, and in terms of Standard Bank's overall assets, I think that's $1 trillion or more. So it's a relatively small part of the market, and that reflects what we were talking about earlier, where there was firm demand for them at the beginning, but since then a little bit less.
Okay, so Standard Bank, would you touch?
Well, look, let's just say if a client comes to us and says, I want preference shares, I must have preference shares, we say to them, no, don't buy preference shares. They say, I want the shares, then we buy them this one. Why? Because if you want that kind of asset, I can't see why you would want to go down the league tables and fish around in the minnows and expose yourself to the underlying credit risk of the issuer.
Okay. Eugene, what I'm hearing from Paul is that if an investor came to him, he would actually be advising the investor to hold the stock rather than actually hold the preference share, even though, as most people say, the world is really in an uncertain place. And we really do not know where we're going and where Europe is going to end up and how hard China is going to land and whether Americans at all, by printing money, will eventually get it right.
Okay, so when we look at preference shares, Paul rightly said that we actually look at the credit of the bank or of the issuer. And if a credit is weaker, and let's contrast, say, African Bank to Standard Bank, you would like to be compensated for the additional risk that you're taking. If you look at preference shares, it's not highly liquid instruments. In other words, it trades like small mid-cap type of companies. If you buy it, you're most probably going to buy and hold this thing for a very long time. It's not something that you're going to trade on a 3-monthly basis. So when we evaluate a stock like the Standard Bank Pref, it's trading at what we call the clean price yield of around 6.7%. So if I buy the stock today, I should earn, given that prime is flat over the next year, around 6.7% gross of tax. In other words, before I'm paying tax. And that's the yield, that clean price yield one needs to compare. If I, for instance, buy a stock like Able, I will earn 8.6%. So what we also do is we look at these preference shares and their behavior over the recent past, the past 2-3 years, and you strip out the tax effects if necessary. And then doing that, we see the higher liquidity bank preference shares, like Standard Bank, is slightly on the expensive side. In other words, if we had a choice, if we had 100 million rand to invest today, would I buy Standard Bank? I'll buy very little of that. I would rather roll down the curve and take a little bit more credit risk, but be compensated for, but selectively.
So for you, Eugene, hot or not Standard Bank pref shares?
Not hot at all.
Not hot. Oh, this is emphatic. Paul?
Look, I've got to be very careful here because I absolutely agree this is a good investment for people who are happy to get their interest slug payments every 6 months. So they don't need their little bit of interest coming in every month to make them feel good. And who are looking for that higher yield. So within that narrow definition, I'm prepared to say this one is hot because I like the credit quality issue. But understand, I'm a growth equity investor. I always tell people to buy the ordinary shares rather.